great pleasure now to bring on board Sameer Khetarpal, Managing Director and CEO of Jubilant Foodworks, to really understand that what is the way forward for the QSR industries. The management is talking about raw material pressure, so I will certainly ask him that who has moved their cheese, because milk prices and cheese prices have been quite a problem for them. And the fact that they're looking at expanding at a time when the industry is going through a cyclical slowdown, is that endorsement of confidence in terms of where they feel that the future investment trend is going to go. Sameer, it's your first time on ET now, it's your first time with me at least, so a very warm welcome and thank you for joining us.
Thank you, Nikunj, and good afternoon to all the viewers of ET Now. I'm privileged to be on part of your show, Nikunj.
Sameer, let's first understand the big picture for the industry per se. Now, if I look at the quarterly numbers of Jubilant Foodworks and the peer set, numbers are indicating that the Indian consumer for the quarter gone by shied away. Do you think this is cyclical, or there is a change in the way how the QSR industry will move for the rest of the year?
Yeah, I think there are a few short-term pressures that I see driven by inflation, driven by some of the pent-up demand that you saw post-COVID normalizing. And as I see the inherent latent or inherent demand in our economy, or what consumers are looking, is over a medium to long term is super robust. So I am not too worried about the short-term changes. I think the tide should turn around very quickly. Because of high inflation, price increases, consumer made choices towards lower ticket sizes, or they moved from a large pizza to medium pizza. But as inflation kind of stabilizes, I do expect this to bounce back relatively sooner.
Do you expect a bounce back in this year itself?
Yes, I think the later half of this year should see, because the base effects of higher inflation will be normalized, and therefore it should lead to more discretionary spending. I'm talking about the macroeconomic in general, but Nikunj, I do want to point to the fact that while yes, you do see short-term mix changes and consumers downgrading, the whole market is like the $50 billion, right? What eating out market is $50 billion. And pizza as a category is about $1 billion. So to me, the competition is, or the opportunity is far, far bigger than how we slice and dice the market, to be honest. So I'm more focused on internal driving technology, building the commissaries, opening stores, making sure the experience is great, launching the 49 rupee pizza to a gourmet pizza at 6.99. I think there is enough opportunity that my team is focused on, and that's what like keeps me exciting, rather than a little bit worrying about some of the macroeconomic things.
Fair point. If I look at the same store sales for Jubilant Foodworks and for Pizza Hut, there seems to be a decline in the pizza demand, and there seems to be an uptick in burger demand. What is your view on the pizza category growth per se? Because that is the big question which perhaps we need to understand and address.
Sure. No, I think I will answer your question again. Firstly, the overall QSR or organized QSR as a service is minuscule when it compared to eating out. So it's less than 2%, and the competition is not necessarily with Pizza Hut or some other pizza selling chain. It is also with a samosa and a vada pav and an idli and a sambar, right? Because that's where the large market is. Now, having said that, coming to pizza specifically, cheese has been a decadal high in terms of price. There was huge, we face unprecedented inflationary pressures on oil, on wheat, and therefore everybody took price hikes and passed it on to the consumer while also looking at internal efficiencies. So I see this category to continue to grow at anywhere from 13 to 15%, maybe higher, once some of the bases normalize. And it is more to do with the price hikes the industry has taken because of unprecedented decadal high prices that we saw. So it should get normalized very quickly, in my opinion, and pizza will continue to grow healthy double digits.
Jubilant Foodworks is always identified as a pizza delivery company, but I look at Jubilant Foodworks differently. For me, it's a company which owns an independent supply chain, has experimented in the biryani space, has got a Chinese business, and has got some global investments. Could you just, share with for our viewers that at percentage of the total sales for Jubilant Foodworks, how much is coming from pizza, and do you see that number changing going forward?
Yeah, I think we don't disclose segment-wise revenue, Nikunj, but of course, large majority of our revenues come from pizzas. And the other businesses are very small and nascent. So Popeyes is just 1 year old. We repivoted our model from Dunkin' to Coffee First, which is a very fast-growing market, and we are growing Hong's as a first Indian brand, or an in-house brand as we call it, and then looking at opportunities outside of India. But so majority of the revenue does come from pizza, but the opportunity again remains. I think chicken is a large market. Popeyes is some outstanding product and customer feedback. In Chinese, there is no organized player, and coffee as a market is expanding rapidly as consumption grows in India.
I'm looking at some of your recent acquisitions in last 2 years. You acquired 10% stake in Barbecue Nation. You have invested 35% stake in a Mumbai food tech company. You acquired a stake in a Netherlands-based food company. What is the thinking behind putting these small stakes strategically, or you think these are the businesses which are future businesses, you would be scaling them up?
So great question, Nikunj, and I think I look at this strategically, and like any other business or a leader in this space, we have to, in line with our strategy, I want this company to be ops and tech focused, right? So therefore, you will see certain investments in technology. The second pillar is we are here to serve consumers in emerging economies. So there are like 6 billion out of 8 billion people in the world, or even more than that, actually reside in emerging economies. So what the playbook for Domino's, which is focused on value, great customer experience through delivery excellence, and an outstanding product, this playbook to me is very applicable outside of India in emerging economies. We've built a strong technology backbone through our own app, where we get more than 11 million monthly active users. We have 13.5 million Cheesy Rewards loyal members who are coming back and asking for more pizzas. So when I look at this backbone, along with the supply chain and the commissaries that we have, that is a very compelling proposition. We'll strengthen the technology. We will strengthen the cuisines or occasions to serve the consumers in emerging economies, be it chicken. And so I view this more strategically. And of course, we have to be patient. When I say strategy, it takes a 3 to 5 year for these investments to pan out.
Missing piece in your portfolio, perhaps you've got pizza, you've got coffee, you've got chicken, you've got biryani, you've got Chinese, is burger. The buzz in the market is that you are looking at making a small and a strategic investment even in Burger King or any other burger chain.
So firstly, Popeyes has an outstanding sandwich, right? And it is in fact known for its sandwiches. And whenever we open stores, we have lines of customers who line outside our stores to have that classic bold Cajun sandwich from Popeyes. We have no plans to invest at the moment in any other burger chain.
Thank you for that clarification. Now, My next question is about what we are discussing with you on numbers for the quarter gone by. That is January, February, and March. We are in March end. So almost halfway done for this quarter. How is this current quarter looking like? I think popped out, and I'm just going to tell our viewers then typically my guests here so that they can hear my voice.
Sorry, this.
No problem. I think I complete this is live television, sir. You can hear me. Would you like to adjust it? We've got all the time. You've caught us at a
yes,
the only thing is this conversation is making me hungry because it is lunchtime for you and me both.
I hope you order pizzas during this for your lunchtime, and we'll deliver you in 20 minutes, hopefully. So no, I think I would say this the price hikes that we've taken, the industry has taken, some of the consumers feeling the pressure of these price hikes. It is I would say take some time for demand to bounce back. So therefore, what we are doing, we are seeing the seasonal uptick that happens because of IPL or from Q4 of financial year into Q1. Those obviously we are seeing it. Equally, we are focused on the internal opportunities that we are seeing in white spaces in the existing cities and also expanding to newer cities. That we have given a guidance of 200 to 220 stores that we will add this year. We are on track to do that, and equally using our the loyalty program, our app downloads. Those pieces we are more focused on, Nikunj, and I think once the LFL growth comes back, we will have I think a very good story over here.
Sameer, I'm just going to break this question for the benefit of our viewers. One is that you will get benefits because of what is happening in terms of cost efficiency, technology management, and also operating leverage which would kick in. But there would be a threshold beyond which you will not be able to squeeze out your supply chain and other factors. So how much more can you squeeze out at a time when you've got raw material pressures and you're trying to reinvest in the business and you're trying to maximize your operating leverage?
Yeah, so I think again a great question. Nikunj, I've spent 10 years as a consultant at McKinsey and then later in Amazon, where continuous improvement is been like I would say something which I've done for a living. I see tremendous opportunity in all cost line items. I shared this in my earnings call yesterday that we have launched something called Project Vijay, which looks at all the line items, right from discounts all the way to the G&A, every line item in G&A or technology cost or manpower cost. I genuinely believe there is enough opportunity, and that opportunity, in fact, I have driven programs which are multi-year programs, efficiency programs. So I do see that kind of opportunity, having spent now more than 6 months in the company. I'm very confident that these initiatives or a culture that I want to build of continuous process improvement, be it starting from discounts to food costs, logistics costs, manpower costs, store operations costs, and G&A, will carry us through, irrespective of how the market pans out.
I mean, it's not for the first time this industry has gone through a cyclical slowdown. That's the nature of the economy. Inflation comes and goes, and when it comes, it is going to have an impact on the business per se. But I distinctly remember when last time there was the inflation issue and consumer was slowing down, Jubilant Foodworks decided to rationalize their stores. You decided to cut down stores which perhaps were not giving you that number. But right now, it's the other way around. What you have indicated is that you would be looking at opening 225 to 250 store, which is in line with your last year's store addition.
Yes. So I think the guidance we've given is about 200 to 225 stores for Domino's and 30 to 35 stores for Popeyes. So I see. Firstly, I think the economy is in a very different state. We've almost doubled from as a per capita per capita GDP from the last time when we in fact what you are referring to as a time frame. The consumption, the discretionary expenditure, the per capita incomes are very materially different from the others. Secondly, we've brought down a lot of data, technology, science, rigor into store opening process. We are a company which prides itself in financial discipline and also taking these judicious calls in opening the stores where we see the white spaces. In fact, we have a whole team of data sciences which looks at how many customers are actually logging onto our site in an area and trying to order a pizza, but we don't serve those areas. That itself is, we have clearly 11 million customers who are coming onto our app and looking for pizzas. So we get ton of data which is giving us the confidence to open stores. We have a very high bar on where we open stores, and when we open stores, they in fact do fantastically well. This is our ROIs on the stores have been intact. We continue to have great return on capital when we open the stores. So there is no reason to say that this new store opening should slow down. We'll obviously calibrate, look at all the demand signals. We'll not be foolish about it. But at the moment, I feel confident given that I've spent a lot of time in some of these small towns and where I get calls that why don't you open more stores? So these stores are giving us the right growth that we want at the EBITDA, and they obviously come at a lower rental and lower manpower cost.
Couple of last follow-up questions, and I'll refer to big trends here. ONDC, how will that impact your supply chain, and how do you think that will change life for Jubilant Foodworks?
Yeah. So I think the good thing about Jubilant is we are channel agnostic, right? We are present on aggregators. We have our own functioning app, and we have more than 1,800 stores where customers can come in, dine in, or carry out. So we pride ourselves in sweating our assets, serving customers where they are. Our tech teams are organized to now launch Domino's Pizza and other brands also on ONDC. So very soon we'll integrate. I think they're figuring out the technologies, how to integrate quickly, and if the demand really is there, we'll obviously be there ahead of time.
But is ONDC more like a blessing in disguise because you have your own supply chain and that is an added advantage for you?
Yeah, I think our own supply chain or last mile logistics, where a pizza box never leaves our hand, is always an asset. And therefore, we take pride in giving the best, I would probably best in class customer experience when it comes to delivery timelines. A pizza box never leaves our hands. The quality of cheese, the antibiotics-free chicken, or no preservatives, no colors that we add. So I think controlling the supply chain for our customers always helps. And good thing about ONDC is we can disaggregate the supply chain and also make it work harder and drive more efficiencies.
Are cloud kitchens and food delivery apps, Zomato and Swiggy, changing your business? Because there was a time when if you wanted to eat the pizza, it would reach my doorstep in 30 minutes, and Jubilant had a unique advantage of a supply chain. That is getting challenged now.
Of course, I think the whole I think good thing what aggregators have done, they have democratized delivery and ordering at home. That has expanded the market, and that is also one of the reasons why we also have 11 million monthly active users on our app. So from that perspective, Nikunj, it has become, I would say the customers are now habituated to order at the comforts of their home. And we, at least to my knowledge, and also the push to my team, is to have the delivery excellence, provide 20-minute delivery in top 7 cities, and make sure there are no defects in the other cities. So from that perspective, I do feel very, very confident that that this whole piece on democratization of ordering at home actually benefits us more than any other brand.
Every apps have built their business by growing by burning cash. They've got growth at any cost. Jubilant has always been a profitable company and return ratios are enviable. But at a time when pressure is coming and when competition is intensified, would you be forced to compromise on your margins just to get growth back?
So I think I'll probably give a couple of data points. Number one being that we launched a 49 rupee pizza and despite inflationary pressure, the quarter-on-quarter drop in gross margin was just 20 basis point. I think the reason why we are able to do it because we have the back-end commissary, the middle mile and the last mile. That positions us to have very low cost structures and hence I'm confident that the margins will not be under pressure because of competition. We are currently giving the lowest price pizza at 49 rupees and can go all the way to 699 gourmet pizza. So from that perspective, we do cover a wide spectrum of consumers. Our strength in back-end supply chain gives us an advantage in the margins. We'll continue to invest in it. Second, I would also add, when we add more stores, actually we get leverage in our P&L. So for example, if I'm adding a 16th or 17th store in Guwahati, then the supplies from our commissary in Kolkata or in Guwahati, they sweat the cost base and therefore it gives me more leverage in my P&L. I'm able to cover customers who are not being served, serve them more efficiently, and last but not the least, we have the app which is a well-functioning app where consumers are loving, and there is a cheesy rewards program which brings them back. So my cost to acquire customer and serve them therefore becomes lower.
Final question, Sameer. I've got a lot of reports. There are a lot of naysayers who are saying that there is lack of visibility in the near term because of the scenario VRM. If you have to use this forum to silence your critics who've written range of reports from a sell to underperform, how would you use this forum to sell and silence your critics who are saying that there are no triggers for next 2 quarters?
So I think I would say there is enough opportunity that I have seen internally, backed by strong customer love that we see in the demand. Even in this inflationary environment, we grew double digit in our orders. Our like-for-like growth on order terms was positive. And wherever we have invested in the right customer metrics, customer value proposition, actually the like-for-like growth has been double digit. Case in point being Bangalore. We launched 20-minute delivery over there. We had double digit growth in like-for-like growth. So it's up to us and my team to execute better, faster, harder, and capture that growth. The opportunity does exist.
It's been an appetizing conversation to see the least that we've really covered a range of topics starting from the supply chain to where things are moving and how demand in a sense could really make a comeback in the second half of this year. Appreciate your time. It's lunchtime, so I know you've accommodated this interview request during your lunchtime, so really appreciate that.
Enjoy your pizza, Nikunj.